Very happy New Year from everyone here at Three Edge Asset Management, and welcome to the monthly view from the Edge for January 2022. I'm Fritz Foltz, Chief Investment Strategist, and I'm joined here once again today by Eric Beageleisen, Director of Investment Research and Deputy Chief Investment Officer here at Three Edge Asset Management. And as we do at the beginning of each month, Eric and I will provide our most recent outlook for the global capital markets, and that's based on our proprietary research model. We have a great deal to cover today, so let's get started. Last year, we identified the early stages of a regime shift, whereby an extended period of falling inflation and interest rates could give way to a period of rising inflation and rising interest rates. And in the first few days of 2022, it appears that this regime shift may be gaining momentum. So now let me bring Eric into the conversation and let's take a look at what our Three Edge model research is indicating as we set course for the new year. Eric, welcome back. And let's begin by looking at our Three Edge asset class matrix. And perhaps you could point out what may have changed since last month.
Sure. Yeah. Thanks, Fritz. Overall, we don't see too much movement on the chart. The U.S. stays at mixed despite some pockets of value that the research finds opportunistic. We'll dive into that a little bit. We find most non-U.S. equities like Europe, Japan, China in that -1 spot now, with some concerns shorter term. Rates and credit are unchanged, as is gold. And commodities bumps back up to that +1 spot. So we'll dive into all these details, I'm sure.
All right, so let's do it. So let's take a look at the major equity asset classes first. And let's start with U.S. equities, which obviously experienced strong year performance last year in 2021. Interesting fact about last year that I read recently was that according to the Bank of America and EPFR, which is a fund flow data tool, investors invested $900 billion approximately into equity ETFs and long-only mutual funds in 2021. And that amount exceeded the combined total from the past 19 years. I mean, that's just astounding. Anyway, so with that as the backdrop, what does the model indicate for U.S. equities now as we head into 2022 and beyond?
Yeah, the U.S. equity market certainly had a fantastic 2021, rising around 27%. And what was it, Fritz? About 80 new highs that were made during the year.
That's right.
Most folks who follow us know we have generally been at or near our minimum U.S. equity exposures for some time due to the extreme levels of overvaluation that we calculate for the region. Unfortunately, valuation is not a perfect short-term timing instrument, but it is quite useful when looking out on average over the next 10 years. All that said, we have identified U.S. value-oriented equities as relatively undervalued compared against the growthier tech names. Our research indicates that these value names may outperform in a new environment of rising inflation and interest rates. Rising interest rates negatively discount future earnings growth, which lowers the relative valuation of growth equities, which are more like a long duration bond. However, value-oriented equities, on the other hand, tend to represent businesses tied more to current economic growth rather than future growth. So therefore, they're relatively less affected by rising rates, much more like a shorter duration bond. And so they may outperform in such an environment. While the Fed has now made it clear its intentions to consider raising their Fed funds rate in March, the degree to which the Fed tightens monetary policy remains highly uncertain, and a more aggressive inflation fighting response than the market expects could trigger an equity market correction sometime this year. So that'll be something we'll certainly be on the eye, keeping an eye out for.
Excellent. I liked very much a comment you made to me a couple of days ago about the reaction of the market to the Fed minutes in December, where it was almost like the Fed said exactly what they had been saying, yet the market interpreted it as being very hawkish. So anyway, we'll see how that all plays out. But let's switch gears now and look ex-US, and let's look at the developed markets, Europe and Japan.
Yeah, with regard to European equities, they're still dealing with inflationary pressures across the continent, which in itself isn't necessarily a problem, but we'll need to watch for any anticipated ECB response in tackling that inflation. That said, we have also seen a recent widening of investment grade credit spreads, while at the same time a narrowing of high yield credit spreads. And this could be indicative of investor appetite reemerging for equity risk in the space. So presumably our research may indicate a more positive outlook in the near term if this trend persists. And then with regard to Japanese equities, we continue to see a flattening of the yield curve measure that we calculate for the region, and also a widening of IG, these credit spreads again, both of which are negative factors for the region. But there are some early indicators of a potential shift in investor psychology to a more positive footing, which, if this continues, like Europe, could lead to a more positive outlook in the short term. So we'll just have to keep an eye on these things.
Okay, great. So let's stay ex-US and look at more emerging market equity indices. And why don't we start with India, which had a really strong year actually last year, up I believe over 20%. What is the models indicating for India equities here in 2022?
Yeah, the Indian equity markets continue to benefit from well-behaved inflation in the region, and the region maintains attractive long-term prospects for economic growth when looking at various measures. Though shorter term, and we noted this last month, we've seen a widening in the TED spread in India. That is this difference between the interest rate that banks charge one another and the interest rate on short-term government debt. Now, this is a notoriously volatile indicator, particularly in India, but it is negatively impacting the attractiveness of Indian equities in the short term, somewhat. So still positive on the region, but we'll be watching this TED measure closely.
All right, great. And let's shift gears and look at Chinese equities, which definitely struggled last year, but it was kind of interesting in that it was more the offshore China equities that struggled. And I believe that in the Chinese A-share market, the domestic listed companies, they actually had a positive year. What's the model indicating currently in terms of Chinese equities?
Yeah, well, we're seeing the inflationary pressures that are in the US also impacting China somewhat, contributing to this negative outlook for the market in that space. We've obviously known about the troubled property developers, and what we're seeing is potentially the Chinese government's handling of these developers may be being well received by investors. As we're seeing investment grade and high yield corporate spreads now for the first time in a bit, beginning to narrow somewhat, which could be a positive for that space and investor appetite returning to equity risk for the region. So we'll be keeping an eye on that, but still not at the point where we want to dive in both feet first.
Those high yield spreads really blew out, didn't they, in 2020?
They sure did.
Yeah. All right, let's shift gears then and look at the fixed income markets, they had a difficult 2021. I think both the Barclays Aggregate Index, the 10-year U.S. Treasury, they both had negative performance in 2021, whereas U.S. TIPS, they benefited from the rising inflation expectations and had pretty positive returns in 2021. So now, as we head into 2022, what's the model telling us in terms of rates and credit in the fixed income markets?
Yeah, as we've noted, inflationary pressures and the potential for interest rates to rise further, continues to pose a threat to both the level of income and the value of bond holdings. More importantly, inflationary expectations continue to rise faster than nominal interest rates. You can note the gray line here rising faster than the blue line over the last 12 months. Therefore, real interest rates, the orange line, and that is the nominal rates less inflationary expectations, remains negative and make nominal treasuries unattractive. However, in this circumstance, we find, as you pointed out, inflation-linked securities or so-called TIPS, a good investment opportunity in the fixed income space presently. With regard to credit, the outlook remains uncertain to negative, with risks to the downside from here as credit spreads broadly remain near all-time tight levels, suggesting the potential for further upside is somewhat limited.
Great. All right, so let's shift gears once again, and now we'll look at real assets, and that would include both commodities and gold. Starting with gold. Gold actually had a positive Q4, but was, as we know, was down for the full year 2021. So what is our current model outlook there?
Yeah, gold remains, and we've said this for some time, gold remains attractive longer term. It's supported by continuing negative real interest rate environment that we just spoke about. Though, as we did note on that chart, if you noticed right towards the tail end, the more recent January movements, there's been a recent upward move in nominal yields, and we're also seeing that uptick in real yields, which may have been part of what was weighing on gold's recent performance. In addition, also weighing on gold may be continued monetary tightening by the world's major central banks.
Mhm.
That all said, gold's attributes as a haven asset and inflation hedge could help gold in an environment of rising prices and increased volatility.
Excellent. And so staying within the real assets, let's look at commodities, which turned in a good performance in 2021. I guess they lagged a bit in the final quarter, but all in all, it's a good year for commodities. What are we seeing there now for this year and beyond?
Yeah, commodities remain relatively undervalued in our model research, even despite the great performance we saw in 2021 and attractive over the longer term. We noted commodities being bumped back up to positive one spot early on here. We're seeing these waning concerns regarding a potential slowdown in the Chinese economy due to those troubled property developers and the government's response. So we're seeing the attractiveness of commodities in the near term get bumped back up because of that.
Great. All right. That covers all of the major asset classes. Eric, thank you for getting us caught up with the highlights from View from the Edge as we begin to navigate the capital markets here in 2022. If you would like the full 3Edge View from the Edge newsletter for January, you can find that on our website at 3edgeam.com. So that will do it for Eric and me. Steve Cucchiaro, Chief Investment Officer here at 3Edge Asset Management, and I will be back next week with our regularly scheduled 3Edge Week in Review. Steve will comment on what's transpiring in the markets in the early days of 2022 and what could be moving the global capital markets for the rest of this year and beyond. Remember, all our videos are always available on our 3Edge YouTube channel, as well as our website, which again is 3edgeam.com. So on behalf of Eric and everyone here at 3Edge, we want to wish you and yours a happy and safe new year and all the very best for 2022. Thanks for listening, and we'll see you next time.